So, analyzing transactions, chapter 2. Accounting systems are designed to show the increases and decreases in each accounting equation element as a separate record. The record is called an account. A T account is a visual representation of an account. The left side is called the debit side. The right side is called the credit side. I like how right here on the board, left side, right side, debit, credit. All right. So here we have the cash T account. So when you're looking at a T account, you've got the T, and then on the top, that's whatever the account name is. So we're looking at the cash account. The left side are all the debits. The right side are all the credits. And then your normal balance for your cash account is going to be the left side. That's the side that normally has a number in it. For assets, the normal side is the left side. So we see here with cash, we started with a transaction for $25,000 as a debit, and then we credited the account $20,000. We have a debit for $7,500. We have a credit for $360, etc. And then at the end, we're going to balance the account. We're going to add up all of our debits, add up all of our credits. And in this case, we have a debit of $5,900. So the balance in the cash account is $5,900, and it's a debit because it's on the debit side of the account, of the T account. A group of accounts for a business entity is called a ledger. A list of the accounts in the ledger is called a chart of accounts. You may see that abbreviated as COA. The accounts are normally listed in the financial order in which they appear in the financial statements. So you have assets, liabilities, stockholders' equity, retained earnings, dividends. Assets are resources that are owned by the business. Liabilities are debts that we owe, stuff that we owe to our creditors, our mortgage payment. The asset would be the home. The liability would be the note that's on the mortgage. Stockholders' equity is the stockholders' right to the assets of the business. It's represented by the balance of common stock and retained earnings. And a dividend account represents distributions of earnings to stockholders. Revenues are increases in assets and stockholders' equity as a result of selling services or products to customers. When we use those assets up or we consume those services, in the process it generates revenues that result in expenses. So when we use them up or we consume the services, it results in expenses. We'll have expenses. All businesses use what is called the double entry accounting system. So every business transaction has to be recorded in at least 2 accounts. So like when we look back at our accounting equation, if you have an asset, if you affect an asset account, you're either going to affect 2 assets accounts or an asset account and an account over here on the other side, because we have to balance. Everything has to balance out. And with double entry, it's basically stating that you're at least going to affect 2 accounts. You can affect more than 2 accounts, but no matter what, one transaction is always going to affect at least 2 accounts. You're never going to just have a cash transaction. It's going to affect some other account as well. So, you know, if you're giving money to somebody and you're just like, here, you can just have this money. You're giving them $500. It's going to affect another account. It's going to, maybe you're giving it to them to keep. So that would be a donation. You're donating $500 to them. So you're going to record the donation and you're going to record the cash going out. Or if you're letting them borrow the money, well, now you're affecting your accounts receivable because now they owe you money. But you're also affecting cash. So you're always going to at least affect two accounts. Double entry. And then total debits recorded for each transaction to be equal to the total credits recorded. Debits equal credits. Kind of goes back up here. Making sure that everything balances out. The double entry accounting system has specific rules of debit and credit for recording transactions in the accounts. The sum of all the increases in an account is usually equal to or greater than the sum of the decreases in the account. Thus, the normal balance of an account is either a debit or a credit depending on whether the increases in the account are recorded as debits or credits. So, the normal balance of asset accounts is a debit because it's going away from the zero. Your normal balance is going to be a positive number. The normal balance for your liabilities is going to be a credit. It's going away from the zero. So that's kind of what they're stating here, depending on whether the increases are recorded, if it increases with a debit or if it increases with a credit. So it just depends on how the account increases. And that can help you to just determine the normal balance of the account, which the normal balance is always a positive number. A transaction is initially entered in a record called a journal. The process of recording a transaction in the journal is called journalizing. And the entry in the journal is called a journal entry. So just know this. So a transaction is entered in a journal. The process of entering that is called journalizing. And the entry, once you have entered it, it is then called a journal entry. Transactions are recorded in the journal using the following steps. And it's cut off. I wonder why I did that. I must have done something yesterday that blew that up. I added some additional questions for you guys. It's not cut. Oh, maybe it's just Moodle because it's not cut off here. So it looks like it's not. It may just be how it's showing up in Moodle. Yeah. So transactions are recorded in the journal using the following steps. Step 1, the date of the transaction is entered in the date column. So you're going to enter the date. The title of the account can be debited. That can be debited is recorded in the left-hand margin under the description column. And the amount to be debited is entered in the debit column. Step 3, the title of the account to be credited is listed below and to the right of the debited account title, and the amount to be credited is entered in the credit column. I would suggest maybe reading through this while looking at an example of an actual journal entry.
On page 58.
Yep. So yep, there's one on page 58. There's a couple actually on page 58, and this kind of goes through. It shows you the different journal entries. It also has examples of the T accounts. So I would probably look at this as well. Because yeah, I'm reading this and I'm like, unless you can physically see what they're talking about, I feel like it's kind of confusing, or it can be. So, step 4, a brief description may be entered below the credited account. And then step 5, you're going to post the reference column, which is left blank, and the journal entry is initially recorded. This column is used later when the journal entry amounts are transferred to the accounts in the ledger. The process of transferring the debits and credits from the journal entries to the account is called posting. Kind of keep, and again, just make sure you know the terminology. The debits and credits for each journal entry are posted to the accounts in the order in which they occur in the journal. On December 1st, Net Solutions received an offer from a local retailer to rent the land purchased on November 5th. The retailer plans to use the land as a parking lot for its employees and customers. Net Solution agreed to rent the land to the retailer for 3 months with the rent payable in advance. Net Solutions received $360 for 3 months rent beginning December 1st. The liability that was created when they received the cash in advance is unearned revenue, because they received that cash upfront prior to earning the money. They've not yet earned it. When a business agrees that a customer may pay for services provided at a later date, we have an account receivable. An account receivable is a claim against the customer. It's an asset, and the revenue is earned even though no cash has yet been received. So we performed the work, they owe us the money, they haven't paid us yet, so we have an account receivable. We expect to get that money. The quality of debits and credits in the ledger should be proven at the end of each accounting period by preparing a trial balance. The steps to prepare a trial balance are, again, maybe look over, let's see if we can find an example of a trial balance.
On page 70.
Thank you. Yep. So there's an example of a trial balance. So step 1, you're going to list the name of the company, the title of the trial balance, and the date the trial balance is prepared. Step 2, list the accounts from the ledger and enter their debit or credit balance in the debit or credit column of the trial balance. Step 3, you're going to total the debit and credit columns of the trial balance, because these need to equal. Part of that assessment. Most common mistake in the assessment was their debits and credits did not equal. Your debits and your credits both need to balance. And that just kind of lets you know that if you're balancing, then you probably put everything where it's supposed to go. Doesn't necessarily mean you did. But if you are balancing, your debits and credits balance, it's a good indicator that you've properly accounted for everything in the proper accounts and using the proper signs. And then step 4, verify the total of the debit column equals the total of the credit column, which is what we were just talking about. An unadjusted trial balance is distinguished from an unadjusted trial balance and a post-closing trial balance. The latter two are prepared in later chapters and include additional information. So we're not going to cover those too much here. A transposition occurs when the order of the digits is copied incorrectly. So I see this a lot. I mean, people that work in the field for years, it's something that's very easy to do. You get into a hurry or whatever, you're typing next, and you accidentally type the 5 before the 4 or the 4 before the 5. And now all of a sudden at the end of everything, you're looking at your reports and you're wondering why in the world it's not balancing. Then you have to go in and spend a lot of time figuring out why. So just kind of note what this is. These are errors that can affect the trial balance. And like we kind of mentioned earlier, when you affect one report, it can affect all of the reports. It can throw all of them off. So you just want to be very cautious of that. If you are, a person that's creating these reports, you want to kind of, check your work, and the more that you do the business, you'll find that there are certain things that'll come naturally to you that you'll know to just, if I look here, I know that it's 99% correct. And if this is off, then I know I need to look somewhere else. And if you're a manager using that information, or you're a creditor using that information, you definitely want it to be accurate as well, because you're making decisions that, could affect the business or your own personal business. So just, making sure that your reports are good. Transpositions are probably the biggest error that I've ever seen. And then in a slide, the entire number is copied incorrectly. So you might copy, and I see this sometimes too, but you'll copy a number, someone might copy a number and there's a space there. And then when you paste it somewhere else, it may turn that space into a 0. Or with Excel, there's different ways to format things, and Excel is heavily used in anything related to business for the most part. Depending on how it's set up, you could copy something over and it copies over as a text, and it doesn't pull that number in the calculation at all because it pasted as a text instead of a number. And so now you're off by $10,000, but because you copied over a number that wasn't being picked up correctly. So just kind of like make a note of what those errors are that can affect the trial balance.
One important note for this is, I'm sure businesses, big businesses do this, just called independent computations, means that somebody's going to check the numbers a second time. So like she would do the math for an account, and then they would give me the same numbers, and then I would do the math for the account, and then they would bump the numbers, and then if the numbers match, then it's good. But if the numbers don't match, then they would check both, like, hey, who made the mistake here, or was there a mistake at all, like type of deal. And I know this because we did this for our numbers when we would shoot artillery. Like they do math to figure out the wind, the trajectory, and all of that, and then they would check it twice. Like they would have 2 people do it. They would have one person do the initial calculation, and then a second person would check that calculation, and then they'd be like, okay, that's good.
Cool. Yeah, they'll do. I've never been in that field before, but yeah, they do. They'll do that, or they'll even have like certain procedures in place where, like in a corporate environment, and actually even some small businesses that are, I guess, mid-sized businesses, you'll have like your assistant level that does all the data entry. And then you'll have the next level that does more of the review. So they review, but they don't go and review everything that the assistant did. So let's say the assistant entered 20 transactions and it came up with this particular number. The next person might look at a couple of those transactions to just spot check. Or they may look at the end result to see, well, this does balance, so she probably entered everything correctly. And then they'll have a manager that'll look at it, and it just keeps moving up until you finally get, to the top of the list of people that are using the reports, the users of the financial statements. But you never ever want to get it, like, you don't want to get it up to that manager or that owner level, and the owner finds something.
Yeah, and then it's like, okay.
So they're like, so you missed it, and you missed it, and did y'all even look at this?
Yeah.
But there are some checks. There's like, because you'll have a couple of different people that will review it before hopefully it's finalized, unless it's a small business. So like I know y'all mentioned owning your own business. Starting out, you're kind of doing everything.
Yeah, you're the CPA, your own bookkeeper.
Yeah, you're everything. So you're probably gonna have some things, some issues here and there and stuff. But you're starting out, it's all on you. But yeah, the larger the business gets, there tends to be an extra set of eyes looking over everything before it gets to you're going to record that as a donation because you have to record it somewhere else. It's there. Any money that goes into your business, you have to show it going out of your business when you take it out. And some of those red flags would be that, well, this company is donating, $100,000 a year, and it's only a small company. I mean, we see big corporations that don't even donate that kind of money. We need to look into them. And then you find out that they're donating the money to themselves or something. I mean, so I mean, there's a lot of. It's really, really hard. And you may have studied some of these, or you may study them later. But there's a lot of accounting cases out there that they base, accounting rules and practice off of because of things that people did before, So, and some of those people even kind of wrote the rules for them because they did it for so long. They were taking a penny out of everybody's account each month. Nobody noticed the penny. Next thing you know, it's lots of money, and they finally got caught. So their problem was they didn't know when to stop. But I mean, if you're getting away with something like that, I guess, I mean, you took I don't know. I'm too scared to do anything like that. I would get caught. I'd get caught the first time I did it. But yeah, I mean, some of these people did stuff forever, and we're just like, but you got to this point, you should have stopped, and then probably nobody ever would have even known, but you had to keep going.
Yeah, what's that? There was one guy that actually did this, and he's famous for it. I think he was Jewish, and then they thought he was really good with money, but it just turns out he was just ripping everybody off.
Or the Ponzi scheme or something?
Yeah, but it was one guy who's famous for it, and they called him, when they finally called him, he was
Ponzi, that's his name.
Probably the Ponzi scheme.
Oh, okay, his name was Ponzi. Okay, I don't know what his name was, but I remember them showing him on the news and everything like that.
Mm-hmm.
I was like, yeah.
Or borrowing tomorrow's money for today, and I don't know. It's just there's so many different things. But that's how we have all of the accounting rules now, and so you just got to be careful. You can't just pull money out of your business and not show it somewhere. You have to account for it. So, and they, you go and you file your taxes, or you get audited or whatever. I mean, you never want to be on the other side. You never want to be on the bad side. So make sure you do everything right. Well, my thing is, let's say that you did take a little bit of money from a company and you got caught. It's not worse. I mean, it ruins everything. I mean, it can ruin your companies. I mean, it stays on your record. You go to jail. You could have to pay lots of money in fines. I mean, it ruins so much. And these days, with the technology and everything that the just knowledge people have, I mean, I would think it's almost impossible for anybody to really get away with anything.
Unless somebody's getting paid to it the other way.
Well, unless they're getting paid, I don't know. But
that's usually how stuff like that happens with companies. It's somebody's getting paid off because they shouldn't be okay, and that's where they're just not checking it.
Yeah, or they're just not checking it, and then they could get in trouble for that because that's part of your job. You're supposed to be competent. You're supposed to be, ethical duties. So I don't know, but anyways. Not me, not my thing, but all right, so errors that do not cause the trial balance totals to be unequal may be discovered when preparing the trial balance or be indicated by an unusual account balance. So this is saying any errors that do not cause the trial balance totals to be unequal. So when we're looking at the trial balance on page 71, we see we've got our debits and our credits. They both equal. We've got $42,600 in our balance for debits, and we've got 42,600 in our balance for credits. So they both equal, they tie. If we made an error, it could potentially make these balances not tie. Let's say when you look at your accounts payable account, we have a $900 credit. Well, if we accidentally put that $900 in debit, that's going to throw our account off down here by $1,800. And we would know immediately. We would say, well, our debits are higher than our credits. It's not balancing. Something's wrong. We did something wrong. It's not balancing out. We know there's a problem. In this slide, they're saying errors that do not cause the totals to be unequal. So that means we have an error in our trial balance, but it's still balancing. It's still tying. So those are going to be harder to spot. Why? Because we're looking at it and we're like, balance though. Everything's there, ties. How is this? How are we off over here on this other report when our trial balance is tying? And the normal reason for that would be there are two accounts on one side that are off. Maybe two debit accounts, and we've messed up somewhere in those two accounts. Maybe two credit accounts. But there's two accounts at least on one side that is off, and that is why our trial balance is off. Or that's why we have an error in our trial balance, even though it's still balancing. So y'all want me to write that on the board? Like kind of draw that out a little bit? Okay. If an error has already been journalized and posted to the ledger, to fix it, we have to create a correcting journal. So we entered this transaction. We thought we entered it correctly. Later on, we realized that it was incorrect. There's an error. Now we have to go in and make a correcting journal entry to fix it. In horizontal analysis, the amount of each item on a current financial statement is compared with the same item on an earlier statement. When two statements are being compared, the earlier statement is used as the base for computing the amount and the percent of change. And now we have practice problems. I think there's 8 practice problems. So we'll go ahead and, so which of the following is not considered a liability? So go through these, identify anything that is a liability, and then figure out which one's not a liability.
Is it more than one on here?
There's one that is not a liability.
Okay, just one, okay.
Just one.
I think it's accounts receivable.
All right, y'all ready? It is accounts receivable.
I had to look in the book to see, because I said it's it. I was thinking of unearned revenues, but I see that they consider that.
Yeah, I was like, that revenue is going to throw some people off.
Yeah.
So, because you see the word revenue, but anything that's unearned is a liability.
Yeah, you can't guarantee that you earn that, so I understand.
Yeah, because you'll probably see questions like this again. So, correct. Accounts receivable it's an asset account. so it's not a liability.
What did you say? Anything that's unearned is what?
Is a liability.
Is a liability.
Because you've received the money for it. They already gave you the drink, but you haven't done the work for the drink. So if you don't do the work, you have to give the drink back. So it's like a payable in a way. It's a liability. And I was using my Powerade as an example. I'm like, y'all are gonna watch this video later and be like, what is she talking about?
What's a good example of account receivable? I'm trying to think of one, like, what would that translate to?
It could be like, you did some work and the person owes you money, so like
Okay. So
you did taxes and you did the taxes for this person, but they haven't paid you yet. So now
Okay.
you're gonna say, you're like, well, I did this work, so you're recording that you've earned it because you did the taxes. You haven't received the money yet.
Okay.
So you record it, so you have it on your books too. So also, it shows that you've earned this money, but you just haven't gotten it yet.
Okay. Cool.
All right. So this one, what did it do that? Why is it doing that? See how like neat this looks over here on the PowerPoint?
Yeah, if you make it big, it throws it all over the place.
Yeah, over here it's mixed it up, jumbled it up a little bit, but okay. So here's the next question. The accounts in the ledger of Monroe Entertainment Company are listed below. All accounts have normal balances, and you're trying to figure out what the total assets are. So we have to identify what all the asset accounts are, and then add those together to figure out what the total assets are. So is accounts payable an asset account? Nope. What about accounts receivable?
Yeah.
Yes. Prepaid insurance?
Yeah, it's prepaid.
Cash?
Yeah.
Dividends?
No.
Fees earned?
No. Yes. Yes, because it's anything unearned is a liability. You just said that.
No.
Insurance expense?
No. Land.
Land.
Yes.
Wages expense?
No.
Common stock?
I think yes. I think no, that's what I do.
It's a
Common stock.
equity.
That's equity. Also, it's a liability.
No, it's not.
Oh, is it?
Equity.
Oh, equity is good. Yeah, I'm sorry. It's asset. Okay.
So accounts receivable, prepaid insurance, cash, and land.
I'll write that down.
And that gives you your total assets of $10,000.
It's prepaid. Anything prepaid is an asset.
Gently Laser Clinic purchased laser equipment for $8,500 and paid $2,250 down, with the remainder to be paid later. So we're trying to figure out what our journal entry is going to look like. We purchased equipment for $8,500. We paid $2,250 down. And so we still have a balance that we're going to pay later.
So they gave us a credit. So we charged it basically. Because if it's $8,000, what we do, said, hey, we're gonna put $2,250 down. Owe you the rest of this by this amount of time. That is a liability, isn't it?
Yeah. Because we have to pay that money out. This is a long-term liability because you're going to be paying, unless you're going to pay it all in full the next time, whenever, or you're going to make that same $2,250 payment each quarter or month or whatever.
So how would we enter this? Let's see.
So aren't you supposed, I think you're supposed to put the entries in as it occurred. So you would start with the 8,500.
It would be a normal entry, cause it's an entry. Is that right? You know, are we on the right track, the normal entry?
Could you pull it up on the PowerPoint? Maybe the one was supposed to go.
Yeah. There, is that, yeah.
Oh, okay.
Yeah.
So how many lines are we gonna have? How many, we need to record 3 separate transactions because we're hitting 3 different accounts. We're hitting, so we purchased laser equipment, so we're gonna touch an equipment account.
Yes, sir.
We paid money down, so a cash account, and then we have money that's gonna be paid later, so a payable account, because we're gonna owe money. So we're gonna have 3 accounts. So you can already rule out one of the answers, because we know we're gonna have 3.
So it's not one, it'll be 4.
You said that already. You said that.
What is it? Number 4? Oh, yeah. Number 4.
It's not a line problem, so you can't really tell, but now that you can see how it's a line, it's 4. But I
Okay.
thought it was 2, just because. I thought it was all.
Yeah.
The equipment's the equity, and then the accounts payable and the cash is the liability. So it makes sense.
Mhm. Yep. So your equipment, you record that at the full amount of the equipment. So that's what. So we've got that 8,500. We paid 2,000 in cash. So I'm just going to abbreviate. So 2,000 in cash, and then 6,000 went to our accounts payable account. So this is your answer. So debit equipment, credit accounts payable, credit cash.
I'm gonna have a similar thing too.
Because you're having somebody like explain it to you as you're doing it versus you learn it all and then do the work. Like, I think you do some like practice problems in 201, but I think it's mostly just lecture and then you do them.
Yeah.
So,
Well, I think everybody's different, and I'll be honest with you. I think probably the first time I taught, I think I did mostly a lot of like, I did some in-class problems at the beginning, and then I realized I needed to do more. So I just like, I kind of changed my teaching style as class went on.
yeah.
But I just,
201 is basically like if you were planning on doing like accounting for a firm, this is managerial account, so you're not going to be doing the
Base level part.
Yeah.
You're just gonna be doing the.
you need to be familiarized with the base stuff, but you're going to be doing more of the advanced portion of, you're not looking at individual, like you're not looking at.
Yeah, you're not including it more. You're just like inspecting accounts, sort of check it, check out records.
That's the air conditioner that came on.
That's been
That's what it seemed like.
is it, or is it, I thought maybe an airplane. But no, we live near an airport, so we have planes flying all the time, but I don't think that's a plane, is it?
Yeah, I don't miss it next to the airport.
Sounds like Pearl Harbor all the time.
Wow.
Seriously. But I mean, it's nice, like they do air shows and stuff too, so it's kind of cool sometimes, but it's loud. All right. So 2 more questions. Which of the following entries records the payment of an account payable? When we pay an account payable, what accounts do we debit and credit?
You debit your accounts payable and credit.
So when we pay an accounts payable, we're going to bring our accounts payable down, so we're going to decrease our liability, and we're going to decrease our cash because cash is going out. We're getting rid of our cash, so it's going to go out.
Wait, say that again. So they,
It's,
We're decreasing the amount of cash that we have on hand.
this is, so it's different.
Debit
Different
and
account
credit.
payable, and then credit.
I'm trying to move with the, there we go, mouse. So yeah, so debit accounts payable, credit cash. And I think this is the last one. Which of the following entries records the payment of a bill for your insurance premium?
That's prepaid insurance.
for your premium, you actually get something. So I would say debit account payable, credit cash.
Prepaid insurance is an asset. So it would be number one.
Oh, no, mind. She's right.
Mhm.
You're
Debit,
thinking-
prepaid.
I'm thinking deductible, not.
Yeah, I'm trying to.
Credit cash. Debit, prepaid, credit cash.
Yeah, I was thinking deductible.
Good job, everybody. Y'all are doing good. I'm like, I don't have to teach y'all anything.
We business. Well, they're not,